The financial crisis was a period of great recession where people lost their jobs, savings, homes, and more. Banks faced pressure and went bankrupt. Unemployment was high, GDP was falling, and the economy was struggling greatly. This was caused by many factors, but the main ones were the housing bubble and a lack of policies and regulations regarding the housing market and the financial sector. The financial crisis greatly impacted many different groups, including the government, households, international governments, economies, and more. It's an important piece of history that we can study economically and learn a lot from. The financial crisis was a time of financial distress all around the world, which caused issues in financial markets and banking, as well as for people to lose their jobs, savings, and or their homes. During this time, not only were citizens struggling, but banks were also losing money and some were even going into bankruptcy. Financial markets and banks were pushed to their limits and were on the verge of collapse. Unemployment was alarmingly high, and the labor markets faced extreme hardship. Unemployment was at 10%, and about 3.8 million Americans were unable to pay for their homes and lost them. During the crisis, prices in the housing market fell dramatically, and many borrowers were unable to pay. Banks began to have losses. Many investors tried to leave the market, and financial firms failed, and some had to be bailed out by the government. This happened globally, and the interbank market froze. Within that time frame, the Fed and the central banks worked together to try and combat these problems by providing large loans to credit markets globally. All of these problems caused people all over the world to panic, and they tried to pull their money out of banks. This made the issue worse. This crisis is important to note for many reasons. Like most pieces of history, it's important to remember and study the causes and effects in order to avoid a repeat of the same problems in the future. Many new policies and regulations also came out of the financial crisis, making it of great importance. One important but controversial policy that was passed to prevent this from happening again was the Dodd-Frank Act, which was passed in 2010. This act placed restrictions on many risky activities of large banks and allowed the government to oversee many of their activities. It also required them to keep more cash in reserves and to put measures in place to help reduce predatory lending. On top of this act and others, interest rates were changed and a lot more regulation was placed on the housing market and on mortgages. For instance, regulations were made to make lending rules fair and to make sure that borrowers were not given loans that would be impossible for them to repay, like were given during this time. The most obvious and probably the largest cause of the financial crisis was the housing bubble. The housing bubble is defined by the Federal Reserve history as an extended period of expansion in U.S. housing construction, home prices, and housing credit. This was caused by low interest rates and under-regulated lending requirements. As home prices increased and were expected to continue to, as well as interest rates and borrowing regulations decreased, many people were buying homes at these extremely high prices. From the perspective of an interested home buyer or seller, the bubble seemed great because they were able to buy houses no matter their financial situations, with mortgages and loans, and sellers could sell to these buyers at high prices. This seemed positive from most perspectives, but turned out to be detrimental in the future. As people bought homes at these extreme prices, many of them using loans, the interest rates and Fed fund rates began to rise and the housing bubble burst. As this happened, the value of homes declined and people could not sell their homes for what they owed, causing many homeowners to default on their mortgages, which were more than they could afford in the first place. This caused banks to lose money, causing them to be forced to file for bankruptcy. One example of these failing banks that led to the Great Recession was Bear Stearns. Bear Stearns began to fail as the Fed intervened to try and stabilize the failing banks. Bear Stearns ended up going bankrupt, but the government decided it was too big to fail and orchestrated the acquisition of it by the bank by JP Morgan for a low price. Many banks like Bear Stearns went bankrupt and failed in similar ways. In order to accommodate all of the new borrowers requesting loans, banks began to borrow more money to lend to them, which might have increased the profits, but also increased their losses, which added to the problem at hand. Many banks even looked for more risky housing loans in order to gain higher profits. When housing prices dropped and borrowers began to default on their loans, the banks were unable to pay back the loans they had acquired to accommodate for all of the borrowing. This caused both banks and the investors who provided the loans to the banks to incur great losses. Even large banks were going bankrupt, and homeowners, investors, and ordinary citizens were losing money. Many banks had to be bailed out by the Fed and by government intervention as the economy continued to decline. Lastly, the financial crisis was caused by issues in regulation and policies, especially regarding the housing market. Regulations on mortgages and on who could borrow were not strict enough, causing many issues. Many large loans were given to borrowers who had no possible way to repay them due to the loose policy. Lax policy was also leading to more fraud, such as borrowers lying about their income and their risk of defaulting to investors. Many regulators also paid very little attention to what was going on in terms of mortgages and lending. Due to this, they did not notice how many risky loans were being given and how big of losses were likely to follow. The lack of strict policy and regulation caused banks to lend people that they should not have money and to lose that money as housing prices fell and the housing bubble burst. From the point of view of the U.S. government, the financial crisis was very significant. They found themselves in great trouble and having to bail out banks and organizations that were too big to fail, while not bailing out smaller banks. This topic of bailing out these organizations is very controversial. Some people believe it was unfair to give these organizations money to bail them out without any form of punishment toward the banks or organizations, nor the executives of the organization in question. However, from the point of view of the government, the bailout of these banks and financial organizations was necessary in order to prevent as much loss and inefficiency as possible, as well as avoid a second Great Depression. The effects of the financial crisis on the government were very large. The U.S. government found itself in more than $2 trillion in debt. Due to the crisis, GDP also decreased by about 15%, or $4.6 trillion. Unemployment also increased, and it is estimated that every American lost about $70,000 due to the financial crisis. Governments were also forced to make controversial decisions and implement new policies and regulations in order to attempt to survive the Great Recession. Aside from all of the economic turmoil, the government was also affected greatly politically and socially as new political and social movements arose from the crisis. All in all, the government saw the crisis as detrimental to the economy and thought that the best move was to bail out the financial sector as needed and attempt to minimize the effects on itself and the nation as a whole. At the beginning of the crisis, prior to the burst of the housing bubble, some households saw the bubble as helpful and appreciated how it allowed them to use mortgages and purchase homes. What they did not realize, however, was the amount of overwhelming debt this was placing them in. Once they realized this, it was too late and they were stuck paying astronomical prices for homes that they had no way to afford. Meanwhile, the value of the home that they were paying so much for was decreasing by a lot. Many Americans lost their homes because of this. Households began to panic along with financial institutions as they started to feel the pressure on them from the financial crisis. As great pressure was placed on households, causing panic, the recession continued to get worse. According to a survey by the National Bureau of Economic Research, as of November 2008, about 13% of households were facing unemployment or trouble paying mortgages. Within a 17-month period up until April 2010, about 40% of households were experiencing or had experienced this form of financial distress. A large effect that this had on households was the high unemployment rate at 10% caused by the crisis, as well as the loss of jobs by many Americans. Households also found themselves losing their savings as banks went bankrupt, causing many people to panic and withdraw their money, which, as I said earlier, continued to make the problem even worse. Economies and financial sectors internationally also felt the pressure caused by the financial crisis. Although it originally started in the US housing market, the crisis and recession spread globally because of the connected financial systems. Banks internationally felt pressures, and a lot of them lost a lot of money. Many foreign banks were connected to the US financial sector because they saw great success in the US housing market and they decided to participate. US banks also did a great deal of business in these countries internationally as well, which added to this. Like households, the financial sectors of other countries saw a chance to profit or receive some type of gain from the US housing market, so they decided to invest. However, when the housing bubble burst, they began to face pressure and the financial crisis spilled over internationally. As can be seen by this, countries whose economies were not as connected to the United States economy and its housing market were better off during the financial crisis than those who were more greatly tied to the US government, banks, financial sector, and housing market. For example, Australia was not affected to as great of an extent because it was less connected to the US, but England and France were affected to a much greater extent. Continuing to look at England and France, according to a source, BNP Paribas was warning investors that they might not be able to withdraw money from two of its funds, and the British bank Northern Rock was about to seek emergency funding from the Bank of England. As can be seen, internationally, great pressure was felt from the financial crisis, but the greater the connection with the US housing market and the US financial sector, the greater the effects on the countries internationally and their economies were. From my research and my point of view, it seems that stricter regulation and oversight could maybe have minimized the issues of the housing bubble that triggered the Great Recession, but it likely would not have been prevented completely. However, people seemed to not be fully aware of what was going on, and I have information that people at the time did not. I think that the crisis was mainly due to the housing bubble and the lack of regulation on mortgages at the time, along with other factors. It was not due to just one thing. Banks should not have given mortgages to consumers who did not have the ability to pay them back. This would maybe have prevented some of the financial sector's bankruptcy, but also it went unnoticed at the time. It is very controversial if the government made the right moves in bailing out banks that were too big to fail or considered so. From my point of view, I think this was very unfair because the same measures were not taken for other companies in other industries or even for all banks. For instance, the automotive industry were not bailed out like the financial sector. However, I would say that the financial sector was more detrimental to the economy, so I think that the government made the move that they saw as necessary to help stop the declining economy. It does seem to be an unfair move, but I think it was an important move to try and help get banks out of tough spots that they were in, which was adding to the declining economy. Overall, I think that this crisis was not necessarily preventable, but without the knowledge we have now and was not preventable because they did not have the knowledge that we have now. The financial crisis is an important piece of our history, and it's important for us to study, especially the causes and effects, in order to prevent a recession like this in the future. In summary, the financial crisis is an important piece of history in finance and economics, and it's very important for us to study. It allows us to prevent several similar issues in the future and also allowed for the implementation of important policies and regulations. The financial crisis was a time of great recession in the global economy where many banks, as well as households, lost everything and faced great financial distress. The United States government, international governments, households, the economy, and many more were affected. The financial crisis was largely brought on by the housing bubble and issues with regulations on banks and mortgages. This spread globally, creating the global recession that was the financial crisis. The financial crisis negatively affected many worldwide, but also exposed flaws in the economies, housing markets, and financial sectors, which has helped us shape our economies and continues to even now.